As we begin to set our sights on portfolio adjustment ahead of the end of the third quarter, it seems a good opportunity to catch up with some AIM stocks with portfolio manager Chris Boxall from Fundamental Asset Management, who joins us. Chris, welcome.
Hello, hello.
We spoke to you earlier on in the year. We've had a full quarter or so since that time, so it's an opportunity to catch up with you. You put together this standard and a high yield portfolio for us. How has the performance been over the summer for you as an AIM, someone that monitors the AIM markets?
It's been tough. It's been tough to make money this year. I think, as we alluded to before, valuations of the bigger, better stocks are very, very stretched. If one disappoints, they fall out of bed very, very quickly. And then you go right down to the riskier end, where we're going to see in some of the higher yielding stocks, which are struggling. Again, they're attracting very little interest. So it's been pretty tough, but it needed to get a bit tougher, quite frankly, and I think it needs to get tougher still for some stocks because, as I said, valuations in some areas look very, very full.
Let's take a look first of all at your standard AIM portfolio put together for IG. This is something that you put together a while ago now. We've seen some stocks come in, some stocks leave, of course, over the period for different reasons. What's your general comment? I mean, you can see here some of the gains you've got, which have been pretty good year to date, but as you said, some have been rather disappointing in the extreme, actually.
One of the first ones there we can talk about is AB Dynamics. It's a specialist engineer in automotive testing. You know, it tests things like suspension, it creates steering robots, and it's been a huge success. We actually went to see the company down in Bradford-on-Avon not long after IPO. It was hugely impressive. Still got a somewhat, well, should we say, experienced founder running things, who owns 32% of the shares, and you can see the performance has been great, and we think the market is highly supportive for its business. It's just announced a big new contract win for one of its new testing systems from a Chinese test house. This was developed with Williams Engineering. The one perhaps doubt in the short term is a recent change in CEO. But it's a really lovely little business. It ticks all the boxes that one could be looking for in an AIM company. High returns on equity, nice cash flow, super growth market, underlying support, founders still driving things. The business itself was established way back in 1982. So it's been around a long time outside public markets, but this has really given it a growth spurt, and it could keep going given the sort of growth we got around electric vehicles, autonomous vehicles. Very exciting little business. Yeah,
okay, that's up 25.8%. Stock that's on the way down. The second one on the list was SIMEC Atlantis Energy.
Yeah, this was the former Atlantis Resources, and it was our speculative pick. And it's originally, when we picked it, it actually performed very well, but there's no support for this stock at the moment. The new name has come about through the acquisition, or the integration of another business called part of SIMEC Energy, and they've introduced Uskmouth Power Station, which is due to be converted from a coal-burning power station into one burning recycled pellets, plastic pellets, and that's hugely exciting. But it's going to need to raise more money to convert the station. In the meantime, it's an early stage pioneering renewable energy business, with its primary focus having been in tidal power, it really demonstrates the problem. There is little interest, in my opinion, on the market for stocks like this. AIM has become a market increasingly of interest to existing, mature, profitable, cash-generative businesses, and there's less appetite for businesses like this, early-stage pioneering businesses that actually could go on to do great things but need the capital to support them.
Yeah. Let's go further on down the list. The stock we've spoken about before is smart metering systems. This is currently down 30.6%.
Yeah, it's a big AIM company, about 600 odd million market capitalisation. Good little business that's, as the name suggests, is part of the rollout of smart meters in the UK. So it's an asset owner. It owns the meters, installs them, and manages all the data subsequently. And clearly, its share price has been impacted at all the negative noise around smart meters. I mean, we've got to install about I don't know, 50 odd million by 2020. Well, that's what the government stipulated. That's now going to be stretched because there's no way they're going to do it. End of June, I think they'd installed about 12 million, so there's a long way to go. And smart meters been doing a really good job, but I just think market noise has impacted its shares. I don't think it's done much wrong. I don't know if you've read, but there's a problem with the integration of these smart meters. If consumers move,
I was going to say there is an underlying problem which has got some very bad press.
Absolutely, absolutely. But they are trying to fix that. So when a consumer moves, there should be a seamless flow of data information to the new supplier. You haven't got to rip out the meter, put another one in, and that's been the worry at the moment, because when people change, literally the old meter has become dumb, which clearly isn't very good. But that's not necessarily smart metering's problem, it's the market in general. And smart metering's been doing a pretty good job. It's a very hard stock to value as well, because it's all about the future cash flow that these meter assets are going to throw off. But we still like it, and we're still supporting it, we're still buying it at these levels. In our opinion, it hasn't really done that much wrong. It's market noise.
Yeah. Okay. Last one on the list I know that you want to talk about was XLMedia, another stock that I think we've got on the list there is down 54.8%.
This has been a short-term disaster, and it's been punished, quite rightly so, but perhaps a little over severely. It's put out an announcement back in June for the year end, for a trading update for December, saying essentially they weren't even going to meet last year's numbers. There have been regulatory pressures in part of their business. They're an online marketing business driving predominantly users to gambling sites. That's their core activity, attracting new sign-ups for the major online gambling sites, and they're very good at it, and they get a revenue share, ongoing revenue share of the gamblers using the sites. But they're very cash generative, very highly profitable, and they've been recycling the cash they're generating into investing in other areas, other online marketing fields, notably towards utilities and financial services. And they put out this announcement. It's hugely disappointing, especially as they just previously raised a whole load of money, which didn't go down very well. So the share price is now broadly 50% down, or actually much more than that, on the level that new investors came in. But we're sticking with them, and
they're cashed up, presumably. They raised the money, so
they cashed up. The CEO bought a load more shares, about £300,000 worth of shares. The finance director bought about £100,000 worth of shares. There were some big commitments, but there's an element of distrust around this business. There's the gambling bit that people don't like. There's the geographical location and where they're operating from, offshore. There are elements of distrust, and this didn't help their cause at all. So they've really got to now deliver, and we hope they will.
We'll see whether or not it manages to get to the cut when the end of the year, if you talk about some of the shifting around in the policy.
We were on the cusp a bit on that one, but we gave them the benefit, because I thought it's just massively oversold.
Let's have a look at your high yield AIM portfolio put together for us. We'll bring up the shares here. We've got this is typically when you have high yield, of course, you get some really big gains, but at the same time potentially some big losses. But let's take this top one first of all. K3 Capital Group you wanted to talk about. Yeah, this 73%.
This is the one major growth stock, I would say, in this portfolio. And when we first picked them for this, the yield, I think, the cut-off was about 4%, and that's what the forecast yield was. The performance has resulted in the yield falling. But it's a business and company sales. It's a business and company sales business where it supports the sale of other businesses. It's got a corporate finance activity as well, and it's now seeking FCA regulation. It's been a huge success story since it came onto the stock market, and terrific top line growth, 50% top line growth. Earnings were up, massively as well. It's really been a great story. However, the risk with this business is if the market softens, it could get very quickly. However, it is endeavouring to move into other areas. We saw management at IPO and were very impressed with the process, their sales process. The way they're attracting customers, clients, and thereafter. It's very slick indeed. And I think they're really giving a lesson to some of the incumbents, the bigger accounting groups who are the kingpins in this area. They're really encroaching in the bigger boys market.
It's interesting, when a stock goes up like this, of course, the yield does inevitably go down. That yield, as you say, dropping from 4 to 3.5%. The next one down, if we can go back to the list, because the next one down is Manx Telecom, which is yielding 7.1%. But you look at the share price performance, and perhaps maybe you realise why it is now yielding 7%, because the price of the shares have come down.
Absolutely. This is a yield play, and in my opinion, quite a controversial one, and what I may say here is controversial as well. This business is gives all the impression of being very poorly managed. Management won't like me for saying this, but really badly managed. It's undertaken a so-called transformation program, which is cost now more than £12 million. This is not that big a business. It's got a virtual monopoly, well, it has got a monopoly on the Isle of Man for broadband and fixed line telecom, and probably for mobile as well. And yet it has not yet had recycled the cash coming off those into other successful areas. So monopoly position, doesn't even pay corporation tax. Suddenly it's having to spend huge amounts of money to transform itself, huge cash payments, and even its reporting, it doesn't actually disclose free cash flow in I would say in a very honest manner. So effectively what you've got here is a business that's hanging on its dividend, and a dividend which is essentially being paid out of growing level of debt. So it carries quite a high level of debt.
But you've listed all the things you've told me in the past as things you don't like and wouldn't like to own. Does the fact it's got a monopoly in the Isle of Man trump all that?
I think it falls into the Warren Buffett categorization of business that it's got such a rosy cash flow that even an idiot could run it. And I feel that, well, again, maybe some more capable people could do a better job. Perhaps harsh, but you look at the numbers, and as I said, the reporting borders on the dishonest. It really hits. Hopefully, it's through the worst. It announced a more positive update about a new service that's coming out. Hopefully we get rid of the transformation. We don't see any more exceptional costs that they conveniently try and hide, or well, they tell us about, but they ignore them out of the reported number, the statutory numbers. It can move forward. But
so long as consumers are happy, and if it's a monopoly, then
absolutely,
they've got a business to work.
Yeah, there's a core there that is doing good things. They just need to use the cash from that to do other things.
Let's go back to the list and take a look at the next one down, which you want to look at, Property Finance Franchise Group, I beg your pardon, yielding 5.4%.
Yeah, I think this may look boring, but it's actually quite an interesting little business. It's a franchise lettings agency business that produces a lot of UK only, and it throws off a lot of cash, and it's at the outlook has been somewhat muddied by the proposed government ban on tenant letting fees, which has resulted in quite a weak share price and questionable outlook. However, notwithstanding that, it's performed very, very well. Largely organic growth, cash is great, dividends really well supported by cash. But the real little hidden in it bought a few years ago a business called UMove, which is one of these online estate agencies. Now, if you put a multiple on UMove that you put to some of these other online things, it'd be equivalent to the group's market capitalisation by itself, without all the nice cash generative core lettings agency business.
So it's worth more than the market cap is at the moment?
I think it could do if people look at it properly. And UMove's profitable. It's very, very small still, very, very small, but it's I think a bit of a hidden gem. And you get a nice dividend. It's just got this sort of Damocles with the lettings agency, lettings fees ban hanging over it. But worth looking at, and you get the divvy. That'll give you a nice payout.
Last stock you want to look at is NAHL Group. We've spoken about this before as well. And the numbers there, I think, show a yield, 7.8%?
Yes, this is it's another good one.
8.2%, I think.
It's another good one to study in depth, to go into the numbers. Again, this is another business that is essentially in the short term paying its dividend out of debt. It's altered its business. It was previously very cash generative and paid a nice dividend as a result, but it's had to change its national accident helpline business model to put more of its own money to PI claims, and as a result of that, the cash that was being thrown off is not. and this is impacting the debt in the short term. But it's whilst the dividend's fallen, it's still maintained at quite a high level. You would say maybe too high given the short-term cash flow, but the market has punished it. It's the type of business, though, that if it can prove that its new alternative business structures are working, this investment, this joint venture investments into claims is working, and they'll start paying out, it could get a very strong rebound. Very strong. It's got a residential related business as well, which has obviously been impacted around the property market. But if that new model works, it could bounce strongly, and obviously if they can maintain the dividend as well. Yep. But it's another thing. There are two companies we mentioned here, Manx and NAHL. It's important for investors to dig into the detail. How's the dividend being paid? Forget about earnings. They're adjusted or mightily. Look at the cash flow and the free cash flow to see if they're supportive.
Yep. Okay, Chris, we've got to leave it there, but thanks indeed for joining us with our look at the standard and the high yield AIM portfolio that Fundamental Asset Management put together for IG. That was Chris Boxall.